Why do some people get approved for everything, while others with the same credit score and income get denied? Banks look at way more than your credit score. They're looking at your entire profile. In this video, we're going to talk about how banks decide who gets access. In the current environment we're in modern times, banks have access to dozens, if not hundreds of data points. They often know more about us financially, behavior-wise, than we know about ourselves. What we don't always know is that banks are compiling all of this data into tiers and ranking, deciding who gets access to the financial resources they need to grow and who gets locked out or left behind. This video is going to give you a full range overview context on how banks decide who's stable, who's qualified, and who isn't. This is going to complement our bank by bank series and financial institution by financial institution series. So going forward, you'll be able to look at every single one of these videos through this lens and allowing you to master the relationship with every single one of these institutions, make those relationships profitable, and leverage those relationships to increase your net worth. So let's look at the first big thing we need to focus on, which is the big shift. There's 3 layers banks use. They have public credit scores, which is what you see, internal bank scores, which is oftentimes what you don't see, and relationship ranking, again, something you're likely not even aware of. Banks have tiers, they have segments, and a lot of times you won't realize this is affecting your very base level interactions with that bank. Everything from access to capital to scale into real estate, all the way down to whether or not they're going to put a hold on your deposit, your check when it comes in. Very important. Most people only focus on number 1, which is the credit score. That's why they stay confused. Oh, my credit score is 760, 780, 700, 800. I should have access to everything. How could they deny me? That's not how that works, but that's what I'm here for, to teach you. So the 5-part access formula, this becomes the framework going forward. All right, make sure you pay attention. Stability signals is number 1. What does that look like? Consistent deposits, low volatility, tenure, banks reward stability, predictable income. Let me run back through that for you. Stability signals are number 1 of our 5. Consistent deposits, low volatility, tenure, predictable income, banks reward stability. So that's number 1. Number 2 is liquidity position. Cash reserves, not excess cash reserves, cash reserves, meaning enough to stabilize that banking relationship and put a cushion behind you so you look responsible. Savings discipline, investment balances, emergency cushion. Banks trust people who aren't desperate. This is what this is about. A lot of people think, oh, I put a bunch of money in the bank and they're approving me or treating me a certain way because they're taking my money and making money. That's only one part of the picture. The list of liquidity position segments I just broke down for you also tell the bank that you're prudent and responsible, and that if you're coming to them for capital, it's much more likely it's for something productive or growth oriented and not out of desperation, which banks hate. And honestly, as human beings, we tend to hate too. Debt structure is number 3. Revolving utilization, installment mix, business debt structure, relationship loans versus random loans. Relationship loans versus random loans. Did I trot in after just being transactional with the bank and randomly apply for some personal loan? Or have I been building data points, interacting on a relationship basis level, and then making it abundantly clear what my goals are and getting capital needed to reach those goals? Big difference, huge distinctions, and banks now have the data to sniff it out. Engagement behavior, app usage, product usage, digital banking activity, card spend volume, direct deposit. Yes, banks track engagement. They know the last time you logged in your app. They know what portions of the app you have and haven't used. So if you haven't checked your credit score in 90 days, not a good sign. If you haven't checked your budgeting tool in 6 months, probably not a good sign. All of that data is actually being stored in most of these financial institutions that have the technology to store it. So make sure you're engaging with these digital services. They're not just there to be cute and fluffy. Relationship depth. multiple accounts that strategically make sense, business and personal, investment accounts, length of relationships. Banks approve relationships, not strangers. And I would agree, as human beings, we're the same way. So there's nothing rocket science about this. Going back to the business and personal portion, there are tons of you that are independent contractors, solopreneurs, or some line of non-W2 worker that keep operating as the personal person. And it needs to stop for many of you. Even if you are an independent contracting bartender, if you're a dancer, if you're a plumber, whatever the case may be, if you're not on a W-2 and you're getting a 1099, you're getting some kind of separate independent contractor tax statement at the end of the year, you are a business entity, my friend. At minimum, you should be looking into sole proprietorship, But 9 out of 10 times, depending on what you're doing, you probably can structure yourself as a full-scale LLC or corporation of some sort. Do your own due diligence. I'm not an attorney, but I'm a banker. And I'm telling you firsthand, the benefits that come from you actually structuring yourself are tremendous as you grow out your finances and organize them that way. Why this matters now? Why does this matter now? Number one is going to be AI job displacement. That is happening and coming at scale. Income instability. We're in an economy that is extremely unstable for many in the economy. Inflation pressures. They have not successfully tamed inflation the last 4.5 years at the time of this recording. Credit tightening cycles. We're still in one. Banks are still tighter than they have been in the last 15 years or so, 13 to 15 years. They're in a tightening cycle right now due to a lot of large scale, macro, and micro level instability. Every day, people are struggling more and banks are leery. Major things are changing on a bigger geopolitical, national stage. Banks are leery. We're in a credit tightening cycle. So banks are going to be even more intently watching who they do business with. When the economy tightens, approval standards don't get looser, they get stricter. When the economy tightens, lending standards don't get looser, they get stricter. Very important. So the excess formula matters more in volatile economies, which we're in right now. What I'm giving you is even more valuable right now at the time you're receiving it, if you're catching this video anywhere in the moderate future or, from it being recorded. So let's talk about real world examples of financial institutions. Some of our favorites are going to be Chase, Navy Federal, American Express, Capital One, even regional banks. All have the same formula, just different branding. Different structure, different branding, same formula. They're gauging relationships. And they're using everything they have available to them, data-wise, information-wise, that you provide them and that you don't know you're providing them, to bucket you, to tier you, to rank you. Every single one of those institutions are all over the spectrum. Chase is the largest full-scale institution in the country. Navy Federal is the largest credit union. Credit unions and private banks, different. American Express is completely virtual. Capital One don't know what the hell they're doing right now. Regional banks, all of these institutions are different, but they're all basically using the same formula. Very important. So strategic move now gives you the action plan, all right? Strategic moves now and this is going to give you the action plan. So apply for credit, strengthen your profile before you apply. You back up. Apply for credit, strengthen your profile before you apply. Make sure you're paying full attention to your financial profile, not just your credit profile, your entire financial profile before you apply for credit. So here are 5 major steps before you apply. So pay attention. Build 3 months deposit consistency minimum. It is true, banks work in typically 90-day cycles or quarters. They are very quarterly. You ever notice banks release their earnings quarterly? Banks are on 90-day cycles, generally speaking. I recommend that you set your first 90-day cycle to be your 90-year cycle. Do it right the first 90 days and the next 90 days and the next 90 days. Number 2, increase average daily balance. Do your best to be increasing, trending in the right direction on deposits. Do your best. It's not always possible, but do the best you can. 3, consolidate banking activity. Stop banking at 50 different banks with $10. I say that all the time. It's annoying as hell, for one. For 2, it's unproductive. Concentrate your efforts into one quality institution. Once you max that out, then roll over into subsequent institutions and bank at the level that they're going to treat you the best. If you can't get a respectable relationship, respectable response, you can't get offers from a bank, you can't qualify for things, then you're not ready to bank there. You're either not a good fit or you don't have the resources to bank there yet. Consolidate based on your financial picture. Next is going to be lower utilization under 10%. Lower utilization under 10%. This is important. Utilization is one of those fluctuating measures that really, really touch behavior. Payment history is huge, but it's very black and white. You either made a payment on time or you didn't. Utilization tells a different story. Your utilization is very, very impactful to your score, and overusage for an extended period of time can be alarming, even if your credit score is still high and you're making all your payments on time. American Express, Chase Banks, these institutions that have the data and the resources, they are cutting limits like crazy, even if your credit score is great and you're making all your payments on time. If your utilization is too high for too long, you look risky, period. So add one strategic product before requesting funding is number 5. Add one strategic product before requesting funding. So look at your existing banking portfolio as far as the products you have with that financial institution, and find something else that you can add into the mix just a bit before applying that you can put to use and continue to add to the picture the bank's going to see of you. All right, very important. So access is not random. That's really the big theme in this video. Access is not random. It's engineered. If you understand the formula, you can stop guessing. The next video, we're going to be covering the formula and how it applies to Capital One. So make sure you tune in, because most of us have banked, do bank, may potentially bank at Capital One, and every single banking relationship should be profitable and should be increasing your net worth. So I'm going to give you this formula. The next one is going to be Capital One. That keeps this bank series going. Comment down below. Let me know what you think about the access framework I just laid out for you. And if you want to jump ahead a little bit and let me know what your relationship with Capital One looks like as we get into that video soon, get that in the description down below as well. I want you to like, comment, share, subscribe, support the channel so the channel can continue to support you. If you're a new viewer and you stuck it out this long, I'm a career banker and financial services professional by trade. I have 14 plus years in the field. I have a mortgage loan originator's license, life insurance license, FINRA investment license, and a small business banker. I have a client relationship book between consumers and small businesses of $25 million in deposits, nearly $50 million in investments, and several million in lending relationships on an annual basis. So you're getting this content from somebody who's bringing this same level of strategy, insight, clarity, and direction to real people and real businesses every single day, helping them increase their net worth and grow their revenues. So you're getting this content from somebody who's real and authentic. So like, subscribe, tie in with us, lock in a community, become one of the pioneers. Other than that, I want each and every one of you to stay focused, stay in motion. I'll see y'all soon.